This is the gold price prediction for next week, the week of July 13. Just a straight read of fair prices, what the data is saying, and the levels that actually matter. If you trade gold, that is XAUUSD, this is the map for the week ahead. Let's start with where we closed. Gold spot finished the week at 4120, down 1.32%. So we came into this new week soft, sitting in the middle of the fight between buyer and sellers. That fight is the whole story. So let me walk you through it piece by piece, top down, the way a desk looks at it. First, positioning. The commitment of traders reports tells you what the big money is actually doing with real contracts. As of July 7, managed money is net long about 116,000 contracts roughly. On the surface, that looks bullish, but when you look at the change for this week, the long barely moved, just up by 364 contracts, while the short jumped by more than 4200. So the new money this week actually leaned short. The big long book is still there, but the fresh bet was defensive. On the wider picture, large speculators are net long 194,000, and the commercials, the people who deal in the physical gold, are net short 221,000. Open interest keeps climbing, and here is the one more flag that we have to note. Speculators now hold 52.5% of open interest, and that read as stretched. When the crowd is in this loaded on one side, the market gets fragile. Now, before you turn that into a signal, the longer term COT index cool it right down. Both the specs and commercial index are near 50, which is dead neutral. Nothing at an extreme. The panel on verdict says it plainly. No setup, so positioning this week is crowded but not washed out. It gives you no clean edge either way. File it as a mild caution and move on. Now the weekly chart, starting with the macro backdrop, because this is the ugly part of the story for gold bulls. Almost every driver that pushes gold around is working against it right now. The regime reads headwind. The driver split is 0% bullish and 88% bearish. Real yields are up, the dollar is up, and when yield and the dollar rise together, that is textbook pressure on gold. Break evens are down, the mining stocks are underperforming the metal. Gold in euro term is down, and gold versus the stock market is down. Seasonality doesn't ride to the rescue either. July on average is basically neutral for gold, and it only close higher about 42% of the time. The forward odds are, you can say, is a coin flip from here. So the big macro picture is not your friend this week, but notice it is not a falling knife either. It's pressure, not collapse. On the weekly structure, you can see gold is bearish. We are printing a lower high and a higher low, with a recent shift in character right around current price. And here is the tension that defines this entire market. The lower time frame, the 15-minute, the 1 hour, and the 4 hour are all bullish, but the daily and the weekly are bearish. So the short term is bouncing inside a bigger picture that's still pointing down. Keep that in your head for all week. Now the levels that matter most. Price at 4120 is sitting right on top of the weekly demand zone that runs from 4059 down to 3884. That self is the floor holding this whole thing up. As long as buyer defend it, the bounce case still alive. Above, the next real supply is way up near 5000. So there is a plenty of room if buyer take control. But below that self, the next serious demand is much lower, down at 3450. So the weekly is simple. Hold 3884 and there is a floor. Lose it and the air gets thin. Let's drop to the daily. The daily structure is bearish, lower high and lower low, with a resistance up at 4180 and support at 3999. The read is clean. The daily wants lower high until price prove otherwise by claiming 4180 on a close. Now the daily wake of picture, and this is the bearish tell for the week. The bias is reading a distribution in plain English. That means the smart money has been quietly selling into strength up in this range over the last few weeks. The last major event was an upthrust about 36 bar ago, and the log shows 3 of them recently. An upthrust is a fake push above resistance that then fail, and it usually means something big is unloading. This doesn't guarantee a crash, but it's a warning that any rally back into the upper part of this range should be treated with suspicion, not chased. But the daily also gives the bulls a counter punch, and it comes from the cycle timing. The cycle through window is due almost immediately, within a couple of bars. In other words, a cycle low is landing right now. The last cycle was right translated, which is a healthy sign. And the next crest is projected roughly 15 bar out. So the timing tools say a bounce is close. Put the daily together and you get a tug of war. Distribution overhead saying be careful, and a cycle low landing right now saying a relief hope is due. Both can be true. The likely outcome is a bounce that runs into resistance and then gets sold. And the first ceiling above is the supply zone from 4236 to 4363. That's both your likely bounce target and your likely fade zone in one spot. Now the 4 hours, where the short terms buyer actually live. The 4-hour structure is bullish. Resistance is right overhead at 4128 and the support is at 4056. Price is pressing straight into that lid. But here's the catch, and it's important. The 4-hour volume reads on the current push higher is flagged as no demand and about half the normal volume. That means the rally into resistance is happening on weak participation. Buyers are not showing up in the size, and rallies that lack up volume tends to stall out. So while the 4-hour looks bullish on the surface, the fuel tanks looks light. On the 4 hours, price is basically squeezed. There is a thin stack of supply right overhead, starting at 4096 to 4131, then 4178. Then that bigger daily supply at 4236 and up. And below the cushion is the small weekly demand self. So it's a caught between a low ceiling and a firm floor. And it needs a catalyst to break out, which brings us the next week's calendar. So the next week ahead is front loaded and heavy, and one event tower over everything. Tuesday, July 14 is US inflation day, the CPI report. This is the whole week in one number. Core inflation month over month is expected at 0.3%, ticking up from 0.2. Core year over year is seen at 2.9%. The headline monthly number is actually expected to come in negative. Here's how to trade the reaction. A hot core print pushes yield and the dollar higher and puts pressure on gold, pointing it toward that support sell. A soft core print does the opposite. It weakens the dollar and gives the bounce room to run into the supply zone above. Don't guess it, let it print, then react. Also on Tuesday and again Wednesday, the Fed chair testifies before Congress in the evening. This is a fairly new chair, so the market is going to hang on the tone about the rate path. Expect sharp two-way spikes around those appearances. It's easy to get, spikes there, so keep your size sensible. The rest of the weeks fills in the background. Wednesday brings producer prices, which are expected to cool hard. Thursday has retail sales seen softening, and Friday closes out with housing data and consumer sentiment, which is expected to tick up. The softening producers' price and retail sales quietly support the cooling inflation story, but understand this. CPI on Tuesday overrides all of it. If the inflation number surprise, nothing else on the calendar will matter. So here is the prediction for the next week laid out as two clear paths. Path 1, the bounce. If gold hold the self between 3884 and 3999 and the daily cycle low fires the way the timing suggests, expect a relief rally. The first target is 4178 and then the supply zone up to 4236 to 4363. That upper zone is where sellers are most likely to reload given the daily distribution read. So a bounce, yes, but into a wall. Path 2, the breakdown. If gold loses 3884 on weekly closing basis, the floor is gone and the doors open towards the monthly demand down at 3450. That's the deeper plus scenario, and a hot CPI is most likely trigger for it. The honest no hype call is this: gold is a range bound with a bearish lean heading into the inflation day. The higher time frame are bearish and distributing. The lower time frame are bouncing but the weak volume. And the whole thing is balanced on the weekly demand self. Two things are telling you not to chase the bounce blindly. The no demand volume read and the stretched speculator positioning respects both. So the bottom line, don't marry a direction until Tuesday CPI clears the smoke. Treat 4178 up to 4363 as fade territory if you lean bearish. Treat 3884 to 3999 as the make or break floor if you lean long of the weekly demand. Keep your size tight around the inflation print and the Fed testimony, and let the levels make the decision, not your emotions. So that's the gold price prediction for the next week. I'll see you into the